Welcome all subscribers across the globe to tonight's Nightly Market Intelligence Report. It's 7:59 p.m. Eastern Standard on July 21st, 2014. Our Smart Money Bias Market Trading Call, providing you with a categoric level for the current state of the U.S. markets, is net neutral again tonight, but that we believe can change very soon as we are poised for a healthy correction to the downside with a lot of opportunities to go short in real time and pick up an incredible amount of accumulated profits in a short period of time. What we're looking at here is a current trading channel that's been established on a Dow Jones Industrial Average that is markedly different price, chart pattern wise, that exists not equally on the S&P equities and our primary market that we trade, the S&P E-mini futures, yes. The resistance level here, this price established and broadcasted out into the future is 17,138.20. That is 17,138.20. Now the Dow closed at 17,051.73 today, markedly down from there with a low. We have a close, open, and a low test at the same level. However, the real level to get through is the union of these prices here, namely the open of this bar at 16,950.93. Because of the width of the trading channel, the inability to identify across the board with most market participants with getting out of this channel to the downside is evident. But for us, we know very well that because of the accumulated volume that's coming here on the Dow and the S&P equities, as you'll see for the past 1, 2, 3, 4 sessions outside of today's minor down close, is more than enough reason to be able to get geared up and look forward to an extended move to the downside and pick up a substantial amount of profits in a short period of time. This is what everybody waits for. This is what every trader who's been trading for a long time waits for, a good short-term correction to pick up a substantial amount of profits in a short period of time. What you'll see on the Dow doesn't exist quite as strong on the S&P equities and the futures, but what we will demonstrate here is obviously two different trendline violations, a first and a second after a peak. And the highest level of strength this particular indicator recorded from the Shaken Money Flow long-term institutional tracker in a long time. This clearly states that the strength of the longer-term money flow behind the inflated highs in the current prices are surely about to change the direction of prices considerably. We have now an extended negative divergence, which once was attached from here to here, now out to this close on this price on the MACD indicator, and across from above to below is evident as being on the way. Now this is something different. We had a strong intermediate, almost a long-term, just short of a long-term negative divergence on the MFI here. Short-term institutional money tracker can't get past current resistance on a failed try from just a few sessions ago and is starting to move down. And look at how this particular indicator's formation has to get out of the apex of the pattern, and we believe that can happen to the downside. Another extended negative divergence out of the SMI as compared to prices. Now this is just the beginning, so let's get right into the S&P 500 equity side, the cash, and take a look at the market difference between the chart pattern and the indicator's more advanced formations versus the Dow. We want to make the case so that everybody can be aware that we are date and time stamping this high probability call that things can move to the downside, so we can post this for the world to see. Here's your accumulated volume again on the S&P equities right here since 7/15. So that's 15, 16, 17, 18. More than enough on an accumulated basis, trying to hide it to drive the prices down. The current levels after closing at 1973 and 63 today, the channel that's been established on the upside, 1985.44, off from that on a failed try to close or open at that level again. strong down close, and here almost the same as the Dow with a higher low. Now this lower side of the channel at 1962 and 29 is still valid because we never got 3 closes below that level. So this still remains the absolute level to get through to really change our smart money bias market trading call to a short level 6 or possibly 7 on the same day, depending upon how fast the market moves, and then change our contract sizing in order to pick up the lion's share of the money in a short period of time every step of the way down. And here's what I want you to see. One trend violation out of the longer term institutional tracker, 2, and now again to day 3. Look at that. Look at the market difference between the price points and how far down the indicator has moved as compared to them. And here, this can't be denied. Look at the short-term money flow index, negative divergence, trendline violation, and then secondary violation with downward momentum today as compared to the prices. Does anybody think besides myself that there's a high probability that this market can turn around and provide us with substantial profits in a short period of time? I believe there is. All the inside technicians are aware of this. People who've come through the door, put their head down, studied here, and here, shaken oscillator, first, second violation. Way ahead of the Dow, isn't it? Yes, it is. And look at what we have here. Negative divergence and then continued momentum to the downside, indicating that the trend officially changed here and has never, ever looked back. The disparity continues to widen as the prices are still at net neutral. How far can the rubber band stretch before prices have to move to the downside? We operate under the pretense here on our end here in our live trading room every day that tomorrow morning at 7 a.m. could be the day. And if it's not, the next morning at 7 a.m. could start the entire sell-off. And that is something that we do every day so that when it happens and where it happens, we're ready for it. So outside of the accumulated volume, compared to the prices and everything we've just seen, let's roll right into the primary market and take a hard look at the near month, September 2014 ES market that we're trading every day. In this case, we have a market that closed marginally down again. And I want everyone to take a look at the levels here. And once again, we remain at net neutral fast forward is because we never had 3 closes below this level. Prices are currently trading mark to the market at 1966 and 25, marginally down from the open, and the trading channel is established between 1977 and 50. Failed tries all the way across the board here to get back up. Couldn't happen. Fading down, 1954.50 is the bottom side. And once that's cut through, and here we have targets laid out on a daily basis here, here. And as prices continue to move down, we will include them every step of the way on all the major levels so that you can use these as price profit targets for support if you're going to sell off anything you're going to sell off. It really wouldn't matter whether it's mutual funds, ETFs, options, longer term holders, stocks. It doesn't matter. The key to successful trading, and I'm talking about putting real green in the pocket, in the account, is learning how to time the market first, which is exactly every single thing that we have done for the past somewhat 12 minutes into this presentation tonight. We already have an open here at this level, suggesting price can continue to trade down to 1942.25, and below that, the next major level is 1923 and 50. Now, traders, pay special attention to this here. What you're going to see here is a major infusion of volume. And you're talking an incredible amount of contracts traded back on 7/17, and that is associated with a down close that got below and through and closed below. What number? 1954 and 50. Everything that we're doing is building the case for the high probabilities of a major market turning point to the downside. Again, was associated with a down close here, this volume. On the indicator formations, SMI after negative divergence to cross, and again here, momentum to the downside. Look at the MACD once again, the negative divergence, never looking back, momentum increases to the downside, disparity widens, and long-term money. Here you have it, one trendline violation, two, and probably, more than likely enough, if we have a down close tomorrow, well, then we'll have possibly one more right here that I'm just drawing in tonight. Let's stay tuned to that. Okay, so now that we've made the case for the higher probabilities of a market sell-off, I was so much looking forward to the sell-off today, and when my watch ended on the trading room at 10:30, it came at 10:38. I saw it, I did it, Brad Logan caught it, and I was happy that he did, because I'm going to present what he did with my contract sizing. And so here we are once again, primary market. And as we look at the MACD indicator in this case, I was in here in a failed try because the setup was good. And then again, shortly thereafter, here in this area on a failed try, right? As you all know. And then as soon as my watch finished, here we are once again with the down move that I had talked about just before the room closed out. And we talked about 60.25 as the target after getting through 1964.50 and 64.25 just took away for major support as laid out by these prices broadcasted out into the future. So on a 15-minute chart, everything was very clear, especially the targets to the downside. And on a 1-minute chart, we'll back it up here. I had a reload on the data. The preferred entry that I had laid out before my watch ended was right here at 1962 and 75. Well, the real end didn't come after that because we had to wait for the result of the volume to kick in. And so it wasn't far away that Brad Logan traded in and got filled at 1962 and 25 at 1038. And then out at 1960.75 at 1042. So in, out here on a dry up of volume, and then a second leg identified here could have been traded all the way down to this target laid out at this point. So based on just one profitable trade out of two, I think the other one he had was 1.75 points if I'm correct, later on, here with the contract sizing that I trade, you're talking about 1.50 times $50 for every full point move is a $75 gain per contract. Times 20 contracts traded was $1,500 US gain on the trade. Now, the important thing to remember is that this is not uncommon. And I had an earlier trade that I took to the short side here that brought me 1.5 points. Everybody saw that in real time, and it was recorded. The failed tries I was unaffected by because I knew that this market sell-off I had felt was going to come. So at the end of it all, what's important is to stay the course, traders, is to believe in what you're doing, and don't let anything shake you out from your confidence and conviction of repeating the same process, the structured, learnable, and repeatable process, right? Over and over again, because you already are on the right side of the probabilities. That is something that almost nobody is. And you can and do consistently perform what a professional needs to do. And that is, once again, stay the course and outperform the market averages by a wide margin. This is Jeff Killian, Chief Market Strategist for the Inside Technician. My pleasure to present to the world, rounding it down tonight, 8:13 p.m. Eastern Standard on July 21st, 2014, with a major heads up for the higher probabilities of a correction to the downside in play. And we will see how this plays it out, and we'll see you again tomorrow on the next Nightly Market Intelligence Report.